Got our news notes ready for this one. Thanks for joining us. Dave Codra here and Josh Friedenson. We're going to go over our kind of updates in the apartment market and multifamily, and then what we're seeing on our assets that we currently have. So it's been a little bit of a shift here in the past 3 months, since we did our last update. And at the end of the first quarter, the apartment market has certainly changed since then.
Yeah,
One dimensionally a little bit, like everyone's only really talking about interest rates, but that's causing the change. So, we're seeing with rates rising, we did this update after rates came out on February 26th or so, from not February, July 26th from the last Fed meeting. And we saw that increase. So that's kind of pushed a little bit of demand down. So we've been less active on that front. But I mean, we haven't bought a apartment deal since 2019. So we have been out of the buyer pool for a long time now.
That was our QOZ run.
Yeah.
We had some good times then.
We did. We got 3. And one of those apartment deals we already sold.
Right. Yep.
So we exited that one coming out of the QOZ. But yeah, we bought 3 apartment deals in 2019. We haven't bought anything since, mainly because the demand for apartments has been unprecedented or crazy. And, when we were looking at doing apartment deals, we'd be trying to buy something and there wasn't even really time to do inspections. Any of that's, buying it with no spread, no yield, only future potential. And it wasn't something that we were excited about doing at the time. But right now it seems like things are shifting maybe a little bit in the right direction, in that less crazy demand.
Yeah, well, we'll see as kind of the market's definitely gotten softer. A combination of, like Dave mentioned, interest rates, and also a combination that, the equity markets have gotten tighter. With the broader markets going down, people's purse strings are a little bit tighter than they historically have been, and it's taken out some of the buyers in the market that, in the way that they buy capital. Institutional funders have gotten a little bit tighter as well. So, there's definitely less competition than there was 3 months ago.
Yeah. And we're taking a deal out. We're in the middle of a sale process on one of our assets right now, the Silverstone deal.
Mm-hmm.
We're still seeing a good amount of offers and bids and all the demand, though. So it's not like it's zero. It's just there's some layer of interest that's not there.
Yeah, I think the brokers told us, like, listen, normally in the first week we have 300 plus people sign the confidentiality agreement. And with yours, we saw only 200. Like, it sounds like there's still a lot of interest. We're doing a tour we're doing 2 tours a day for 3 weeks right now. So
yeah, so still lots of, I think it's, is demand slowing on that front? It's like, sure, but is 300 reasonable? That seems like that's crazy.
Right.
Other parts that are happening kind of in the market as a whole, we want to look at a couple of things. One, interest rates. We talk on that part. 2, in the inflation part, right? Inflation is driving up costs, and we're seeing that in our cost structure going up. We'll touch base a little bit on that, but it's also got the aspect that it's driving up rents. Within the market, you hear rents going up 20, 30%. The news is always going to find one like individual instance.
Jersey City, right? Jersey City.
Jersey
It made the
City,
headlines this week.
The most expensive place to live now in America, but they're always going to find.
You want to live in Jersey City? I don't want to live in Jersey City.
I moved to Atlanta for a reason. Yeah. There's always going to be some outlier of craziness, but we are seeing significant rental rate increases, and also significant just general revenue increases. And that's the market as a whole. Everybody is seeing that. But another thing leading into that, with interest rates going up, making home ownership, new home sales or listings and that kind of stuff is slowed dramatically. But again, it used to be you had to offer to buy a home like the day of at 20% over asking price. None of that seems like a normal market. So with that kind of slowing down a little bit, it's going to put more people into renting. So if a mortgage cost is, they just hit over 6% briefly, the average 30-year mortgage, and it's back down in the high 5s right now, which again isn't totally bonkers.
Right.
But that's definitely going to put a slowdown on people buying homes and push more people into renting. So you have 2 factors affecting rents just holistic, which is that, not as many people buying a home, and then inflation driving rent up. And then overall, there's still a supply constraint. I mean, there have been in almost every major city, there've been a ton of apartment units added to the mix, but I think they're still talking really everywhere of a housing shortage. So
Yeah, especially here in the Southeast, you look at the, Dallas Fort Worth market where we're seeing, very significant population growth, mostly from positive net migration from other parts of the country, on top of our natural population
natural
growth.
yeah.
Yeah, that keeping up with that housing demand has been challenging.
Yeah. And in the past 2 years, certainly it's been more challenging to get deals off the ground. Underwriting has become harder. Also, just permitting process, everything has become more challenging. Supply chain, you throw all of that stuff in, it's causing deliveries to take longer than normal on the new supply. New supply doesn't really affect what we do, but it does affect pricing and the overall market as a whole. Because the pricing on new apartments is very different than the pricing on deals that we invest in, right? So that's kind of where we see things, on the market as a whole, right? Like there's still a lot of demand out there. There's still people aggressively buying multifamily, but there's definitely a slowdown from, call it 6 months ago, or from the peak of that craziness.
Right.
And again, that's a big reason why we haven't bought anything in, 3 years now. Is that 4 years?
Right.
3 or 4 years. It's a
Right.
while that we haven't bought anything now because of that. So if we look at the deals that we're participating in, the deals that we've invested in, pretty much everything we have is on a fixed debt position. We've been big proponents of that over the years. We've done most of our loans with the Freddie SBL program, and almost all of our debt. Now, even on the mobile home side, we've gotten into Fannie Mae loans on everything, which gets us, the longest we can do is 10 years, but that's still
Right. So pretty.
that's still pretty good.
Yeah.
And the majority of our debt is fixed around 3.4%. So I feel like that's a very good position. We've been targeting to do that for years on our strategy. So that puts us good there. The part that is impacting us, though, is the inflation part. We look at the performance of our deals across the board. Any of our end of quarter reports, any of our financials, we're seeing that our costs are up really across the board, right? We got some of our numbers, wages are up 8%, materials 40%. Contracted services are up 35%. So these are big increases that we're seeing, and that covers everything from, we got to buy new paint to turn a unit, we got to buy carpet, we got to have carpet installed, HVAC systems, all that stuff. But it's being countered by the revenue gains. So our revenue gains, year over year, we're up about 9%. We're up 2.5% on revenue, not rental rates, revenue.
Yeah, so let's talk about the difference between revenue and rental rates. There's kind of a distinct kind of evolution of realizing revenue as you increase rental rates.
Yeah, I guess you've got to not only increase rental rates, you then have to rent that unit, collect that rent to result in revenue increases. We're always talking about revenue, whereas most are looking at rental rate gains. So if we take a unit offline, and then we say, hey, we're gonna raise rent 25%, and it sits there for 2 months. It's like, sure, we can say we're targeting higher, but that doesn't produce any revenue. So when we look at our rental rate gains, on average we're seeing between 10 and 15% rental rate gains, and we have always looked at our retention numbers. If we go too low in retention, we get really hammered on deals. Some of our deals that we had low retention or low paying retention. That's why we sold the Heritage deal. We had issues with that at City View starting out, where retention was in the 40% range. That's very challenging.
That's one of the big reasons why we always focus on more on larger units with multiple bedrooms and bathrooms. So they're more lifestyle units that had less turnover, less transient population, more family oriented.
Yeah, even 1 year. Like when we think about what is a short-term rental, like a 1 year, it's like, oh man, we got to go turn that again, and it's going to cost us $2,000 to $3,000 to turn that unit.
It's 2 or 3 months of rent.
That's not a great investment,
right?
If we had everyone that vacated over 1 year, like that would be, our deals would not work. That's not sustainable. So we need to have longer term residency for our deals to cash flow to work. So right now we're seeing our retention is over 60%, which is okay. We target 70%. That's really what we want to be at, but we hit over 60%, really 5 months in a row now that we've had over 60% retention. That's good. It's not phenomenal,
Right.
but it's good. We want it to be higher, but with that, we're getting 10 to 15% rental rate increases. So on deals where we see a 2 to 3% revenue gain in a quarter, that means we had about a 10 to 15% rental rate gain. And again, only just flatline average it, only 25% of the units can turn over in a quarter, right? So you
Right.
can you only even have the option on 25% of the units, and of those, 60% of the people are staying. So we now have a much smaller portion of units that are turning over that you can aim for larger rental rate gains on.
And we've managed this over the years, really just looking at, if you look at the extreme opposites in our portfolio, which is Saddle Creek's a good example of like basically a full retention property. We generally have 90% plus retention because
Correct.
our rents are restricted. And so we can't realize the market gains. The other properties around us are what, double the rent?
Yeah,
Three times
the
the rent?
rents in that Saddle Creek area in Alpharetta, Georgia are crazy compared to what we're currently renting at. Our average there is about 1,100. And when you look at some of the stuff in the immediate area where a townhome goes for 4,800. Granted, we have, 2-bedroom apartments, so not comparable to a townhome, but a townhome at 4,800 and a 2 or 3-bedroom apartment at 3,500 is a lot different than 1,100.
Right. So on a property like that we're basically really soft on the rental rate increases, we get really high retention. The polar opposite is if we get more aggressive with rental gains, like a lot of properties when we first buy them, we have very poor retention. And we have to spend lots and lots and lots of money on turning these over. So we found that the sweet spot is right around 70% retention. And if we can manage that level, the expenses are manageable, the revenue gains are manageable. They're not market revenue gains, but they're still in the great positive direction that we can keep up with.
When you look at all of our deals as a whole with retention at 60%, that is above our budget on the expense side. So all of our deals as a whole, 60% retention for this second quarter period. And that put our expenses above plan because we're targeting 70%. So we're targeting even with the rental gains we're hoping for and targeting. With that, we're over on expenses just collectively across the board because of that. And that'll dip into lowering the cash we have in our reserve accounts because we're spending it on these turnovers. And then ultimately that lowers distributions as they're coming out. With that said, though, it's not like we're taking units offline and then not renting them. Our overall economic vacancy in the quarter was 7%. So, we look at, hey, were we rented, we look at our annual reports, we're rented for 97, 98, 99%. But what that doesn't account for is like how many actual days we're vacant. So when we think about 60% retention, if we have an apartment that someone moves out and it takes us 2 to 3 weeks to turn it, clean it, paint it, get that new person in on also that new person's schedule, right? We don't dictate their schedule when they're ready to move in, which is typically a weekend. And it takes us 2 to 3 weeks. We've now lost, 15 to 23% of that month, 2 to 3 weeks out of 90 days, right? You've lost 15 to 20% of potential occupancy because of one turnover. Now, when you multiply that by 60% turnover, that's where you start seeing a 7% economic vacancy, which is, by that, I mean the total, if every single day were rented, on average, we were rented for 93% of the possible days out there, which comes into play because of the turnover. So the other part of that is just driving our costs up. You mentioned that if we're paying more for these services, really all of our costs went up collectively from year over year till now. I don't think we have anything we saved money with necessarily. So those costs all going up definitely impacts how we execute the business. But right now, it's like people that are strong operators that are able to build in how they manage their leases, how they have good retention, right? How they manage what costs they're paying, how those contracts work. That's really going to separate what assets perform well and what assets don't.
Yeah, as we go to this next part of the cycle, where transactions might be a little bit tighter, where debt's definitely a lot tighter, and interest rates are higher, and basically lenders are getting less interest only period, higher rates. It puts a lot of stress on operations and actually holding the deal and operating. And so that's where we're primarily focused.
Yeah, and we've kind of always led with operations. That's been our core. Like, how do we execute a real estate deal as we operate it? That's why from the very beginning we've done our own property management and done as much of it in-house as we can to make sure we have control and can really see what's actually happening. Not trying to interpret something third-party report. Like, we can really see what's going on with the operations of the business. So now in this kind of phase of when we look at a real estate asset, how do we know if we're doing the best we can with that asset? We have a couple deals where we don't have any equity left. We've returned all that equity, and we're seeing our margins improve. So on an operating standpoint, in the current environment we're at, we're seeing good rental rate growth that's outpacing expense growth, and we have fixed debt. So we're seeing our margins improve on most assets. Whereas we have some where, and this is more localized to different areas, where expenses were outpacing what we're seeing on the revenue side. And those deals we're still looking at exiting. So we have one deal in Charlotte and one deal
Silverstone, yeah.
In Greenville that we're like, okay, these are probably candidates to sell. And although the pricing is definitely lower than probably 6 months ago, it's still
incredibly high.
It's still very high. We're still doing very, very well. And buyers looking at those deals right now, when people are coming, they're really only underwriting the existing cash flow. There's no more like theoretical cash flow debt that's available. Right? So you have to have real financials that are people buying, which is really how an investment deal should work. You should have real financials that you're purchasing off of. So people buying the deals now, they're underwriting it based on the actual performance of our deals that they're going to be able to buy that off of. And the debt that they're going to get is based on that. That also opens us up to doing the same thing and potentially finding some cash flow in multifamily deals here in the near term. Not right
today.
Now, not today, but optimistic. We see closer. I think we're closer to that time where we find a cash flow deal in multifamily that we would buy in the Greenleaf form than we were 6 months ago.
Yeah.
So that part's positive.
Right.
So I want to go over just like, CoStar is a big report system that we use. They kind of aggregate all of our information. You're asking like, where are we in this cycle? Should we hold in this cycle? Should we sell in this cycle? Like, is there any key indicator that's going to give us that answer? And I don't think there really is one key indicator that tells that. But CoStar, we've always looked at like revenue growth. I think we've really always been focused on, if we can see growing revenue, we see ways we can hold assets and continue to operate them and perform.
We see opportunities to continue to invest in them as well.
Yeah. We have like our Kingstown deal. We just completed a project at our Kingstown deal where we were able to invest about $17,000 and we had a $500 rental rate bump. So that's a
monthly rental rate. Yeah.
500. So put that together, that's a payback period of 3 years. Right? What we spent, $17,000, the additional revenue we're going to gain, we'll earn that back in 3 years. When we think about all the investments that we make, if we can earn money back in 3 years, we see that as a good opportunity. That's kind of a back of the envelope number. That is not there's no advanced analytics going into that. That's if we spent $17,000 and we can get $5,800 back, we do that for 3 years, we're in good shape. So we're still looking at all of our deals in that lens where we can do that. And if we can, we're excited to hold them, operate, and keep earning money on them.
Yeah, it validates that the deal is in the right market, is growing, has all the right trends and metrics around it. So that we want to further bet on that.
Yeah. Now, if we don't see that though, that's where really over the years, all the deals we've sold in our model and our thinking, we didn't see that, and therefore we're like, hey, we should exit this asset.
Right.
We've kind of taken it to where we can do it. But now it's someone else's turn.
Yep.
Okay, so that's where we're at on the multifamily side. Right now, we're definitely in a hold and maximize our margins, and we're pretty excited about that with the assets that we do have, with fixed debt, with growing revenues, and although growing expenses, revenue is outpacing that. So we like that position for everything we're in, and we're optimistic that in the nearer term, we can find some opportunities for cash flow multifamily.
Right.
So we want to open it up to questions and go through, see if anyone has anything on this one, and hopefully provide some more clarity if anything's else out there.
All right, first question. Generally, will income continue to outpace expenses?
Well, right now, two factors we have that are helping in that answer. They're not perfect, but they're helping is we're actually seeing a lot of wage growth. Like wage growth in the economy right now is pretty significant compared to really from like 2014 to 2019, wage growth was pretty flat. So it's hard to have revenue growth in a rental environment when the income earner is not making more money. So that's a hard story.
Right. And from a rental standpoint and even from a home sale standpoint, that debt to income ratio, being around like 35%, maybe as high as 40%, that's a real thing. That's what people can basically afford to
Should be a
operate
real
on.
thing.
Yeah, exactly.
Right. They shouldn't be paying more than that because it's not sustainable. But with incomes rising, that means revenues that they're going to pay into either a home or into a rental environment are going up as well. So there's that, and then there is the inflation part that's driving that too. So in the short term, it certainly looks like revenues are going to keep outpacing expenses. And in the deals that we've been able to hold long term, I mean, we've owned deals now for 8 to 9 years, where over that time frame we have continued to see and operate in an environment where we can find a way to grow revenues over expenses. As soon as that shifts, that's when we would be, looking to exit a position.
Mhm.
And our definition of that shifting is different than.
Given the financial climate, is right now a bad time to sell?
I don't necessarily think it's a bad time to sell. Do you? I mean,
No, there still seems to be plenty of buyers out there in the market. Multifamily is definitely it's been and continues to be the sweetheart, in commercial real estate.
For a long time now.
For a long time and continues. Most people, most of the media is driven and the news reports are driven by what kind of the institutions out there are driving, and they're moving more and more chips towards multifamily. So, and then everyone follows those trends. Multifamily seems to continue to be hot.
So is it a good time to sell into it though? It's like, I think in one of our deals or any deal that's on, I was like, if they're not confident how that deal can be operated, they should probably sell it.
Right.
Kind of whatever really that time frame is. If you're in a position where, or us or anybody, if you're like, hey, I can't operate this thing and it doesn't seem like it's going the right direction, like that's probably a pretty good time to sell it. So anything we have that's in that boat.
And last but not least, our process question. Quarterly reports are dated for the end of June, but when do distributions actually arrive?
Josh is laughing over here. We've been trying to hammer this one home on kind of how we operate within the business. And over the years, we're trying to be as consistent as possible. And now we have all of our reports that come out on the 20th at the end of the quarter. So the 20th is what triggers then distribution. So everything hits around the 21st, 22nd. But yeah, in our investment portal and on our financial statements, we put everything at the end of June. So you see it, you really see this stuff hitting at the end of June, but true cash distributions are not until 20th of the month. And they probably hit around the 21st, 22nd into a person's bank account.
Yeah. And when you look at them in your bank account, you can look at the details, and under the details, it usually says like MGMT and, some numbers. If you look just past there, it usually gives you the details of which property that came from. If for some reason you don't get those details at your bank, you can always go to our Juniper system, open it up and tie the numbers to each property. And it's pretty easy, or we can show you exactly how to do it. It's pretty straightforward though.